Welcome back to the final hour. It is 3 p.m., February 3rd. Is it Wabbit season or duck season? I just posted this in Telegram, thought that was pretty fitting. We've got bull market, we've got bear market, bull market, bear market. There's your rabbit season, duck season. All right, so market can't seem to make up its mind. Here's what we had. Tariffs announced on Friday. Market reacted to it unfavorably on Friday. That was the close. Here's SPX dropping from around 1 p.m., just after 1 p.m. on Friday into the close. Took out the recent Thursday, which was another tariff reaction. So anyway, I wasn't surprised, and I did say this last week. As we approach the weekend, I thought, well, if we're having tariffs go into effect, don't be surprised to see the futures market open up potentially lower on Sunday. What happened? Futures market way lower on Sunday, and this is our gap. So gap, pushing lower, lots of pressure, and then rip to the upside all the way back up near a gap fill. All I did is just stayed out of the way. Doesn't mean I didn't trade. I was actually quite active today. I had 59 trades placed throughout the portfolio. Most active on my personal account here, 13 trades, 8, 6, 6. A couple other ones, 6 and 4, 6. So a lot of trades added up today. Just getting more positions out through February, March, and April right now. And I actually have a trade that I'm going to be looking at closing here in the next 58 minutes or just let it expire. I have a profit trap on a broken wing butterfly for the SPX. The premiums were decent. So when this sold off right here, the 6150 and 6150 area is what I was watching. Or I'm sorry, the 6050. 6050 is just above this current liquidity level, and we've got a gap fill around 6040. So here's the trade right here. For 45 cents, I did a broken wing butterfly, and it is a 1-2-1. And let's see if I can analyze that. It's going to be a little messy there because I got all these other positions. So easier if I see just the trade itself. Basically, it's this. If price stays below 60.55, I keep the 45 cents credit. If price comes up to 60.55 or 60.60, I get bonus dollars on that profit trap at the end of the day, which since I'm live for final hour, I can manage that trade into the close. Anything at like 3:30 p.m., 3:40 p.m., 3:50 p.m., looking to grab some extra credit. Realistically, though, it's probably not coming to 60.55. Here is the current price. We're trading at about a 4 delta right now at the 60.55. So my profit trap is at 60.60. There's a 3% chance with current prices that it gets there. Now, we could have a big surge into the end of the day, but that's unlikely. So I'm probably just going to keep the 45 cents credit on top of the winner that I took early this morning, which was for 40 cents credit. So on the day, 40 cents in the SPX, another 45 in the SPX. That wraps up to be a pretty good day. And I'll take that anytime. If price does go higher, then I have a little bit of a buffer there. So it's fine by me. Okay, so let's put a happy Monday out there to traders watching. And if you're watching on youtube.com/financial wars, youtube.com/Chris Pulver, I post this also. This live session, this final hour is on Facebook. It's on LinkedIn. It's on my Twitter account. So it's all over the place. I do need to get back in the habit of probably every couple of weeks doing a trading view video. So we'll get that as well. Let me ask. I've got a question to ask real quick. Custom. Okay. Let's see what else. A lot of trades today. Called out some in my Pulver alerts. Put on some earnings trades. CMG, AMD, PayPal, earnings play. Also index trades. I did an index trade today on SPY. Index trade on SPX. Index trade on QQQ. Overall, pretty active. Daily profit play, active. Waterfall income, active. Good classes, live classes. If you're in those services, waterfall income. Today's a great recording to review. All right. If you're in the daily profit play, a great class to review in addition to last week, the 27th. 27th, 8th, and 9th. I had a lot of new traders, a lot of new members coming into those services. And so a lot of education and trading last week on the 27th, 8th, and 9th, and the waterfall income last week on the 27th, and today, the 3rd, just to explain in full detail like why I'm taking the trades that I'm trading, a little bit of flexibility and modifications on the waterfall income side, but for a high probability of profit and a lot of flexibility in the trades themselves. So if we go into the markets, I mean, I just think you need to be ready for a lot of indecision. I mean, the market is clearly overreacting and then changing its course, changing its tune. So that's one trade I've got right there. That's fine. So look, I just think it's going to be difficult with all the potential trade war stuff getting right, right in the markets, right in the trenches right away to start off 2025. I mean, by the way, this, if I'm not mistaken, might be the first or second. Is this the second uninterrupted week of trading? I think last week was the first full week of trading with no holidays or market closures, because before that we had the inauguration on the 20th with MLK Day, so markets were closed. Before that, Thursday the 16th, we had Jimmy Carter's Memorial on the 16th. That was the Thursday, and then the 6th through the 10th was a full week of trading, but like really light after the holidays. I can't remember if that was a full week or not. If it was super light volume. We came back officially kind of on the 13th, but again, disruption, markets closure, 4 out of 5 days. Anyway, I feel like now it's kind of full season or full trading is kicking off, right? So I've said this for the last couple of months. I would be shocked to see the market go up with a lot of momentum. I'd be shocked to see the market go down with a lot of momentum. I think we're going to have to be dealing with a lot of this. And I, of course, don't know the timing of it, but expect there to be a lot of headlines, a lot of market sensitivity, a lot of drama that doesn't necessarily mean any follow through. So if you don't have strategies that can adapt to a reaction but no follow through, think about trading options. I mean, I'm not going to sit here and say like today's market move was a chase. It's like I'm not forcing down trades, I'm not forcing up trades. I'm just staying out of the way. So a lot of my trades are out here. If the market's going to drop, fine. I still think there's a lot of resiliency built into the markets. I think there's a lot of optimism the markets are hoping for this year. I printed off this little tidbit, which I think could be interesting. So kind of best case scenario for right now. Let me see here. Give me one moment. Okay. Okay. So best case scenario. I just pulled this out of Opening Bell Daily with Phil Rosen. He's on a lot with Anthony Pompliano and other stuff. But Opening Bell, good newsletter, is like 190,000 subscribers. So here's best case scenario for right now. What the market is dealing with is we have a sensitive market, right? So where we having trade war, and if we are having 25% Canada, Mexico, which are trade partners, this would be basically tariffs that would make it probably more favorable for the U.S. or at least more comparable for U.S. I mean, I think the ideal scenario is that we have a win-win. Canada gets something that they want, Mexico gets something that they want, U.S. gets something that they want. If this is a bully tactic with U.S. being like world number one, largest GDP, ridiculous amounts more, imports and exports, it would dwarf Canada, Mexico. And I saw some images on that earlier. So it just depends on how gracefully or tactfully we're handling this. You throw China in the mix. So we'll put trade war with allies, right? Mexico, and even put Europe in here. What about trade war with frenemies, right? So that would be China, Russia, BRICS nations. We've already seen the threat of 100% tariffs on BRICS nations. So I think in theory it sounds pretty simple. Look, if you want to make things in the U.S. and create jobs and create your gadgets and gizmos in the U.S., you'll get the best tax benefits, which is part of Trump's big plan is to have tax breaks. But if you want to make things not in the U.S., then you're going to pay a ton in tariffs. And unfortunately, this is how the administration led in 2025. You take office, you put in trade war tariffs, right? So this is why the market is super sensitive, because is it going to be good for the economy? Well, in the near term, we'll say sensitive, how bad, how good do these, let's say tariff, or I'll put this, are tariffs negotiated? Are they negotiated? Or are they retaliated? Right? That's the one thing that makes it worse. Is it going to be, look, here's what we're proposing. Let's come to the table. Let's talk about this. Let's find a win-win. But if it's just we do this and then you go back at us and then we go back at you and it's just eye for an eye type stuff, this retaliation is not going to make things better, right? So markets are sensitive to this. It adds global economy friction, right? So supply chain disruption, prices increase, and businesses pass on increases, and the consumer ultimately is stretched thin. So if the consumer breaks, things don't get bought, things go down, stagnant earnings, higher inflation environment, all these things. Like, this is the unknown. This is where it gets bad. So best case scenario, here we go. Where do you see copper at the end of the year? Doesn't matter. I'm only interested in copper if it comes back down to give me an attractive price. I think we have to have some, it's called Dr. Copper for a reason. So they say that, copper is always a good barometer benchmark for the economy. Let me go to this chart here and go to copper. So I'll just go HG for copper futures. Go to a higher time frame. Let's go 8 hours. So all I see in copper right now is a ton of support down here. Okay. And some near-term support right here. So does this structure end up breaking? Right? I mean, right now copper doesn't look good to me at all. So I looked at this. I wanted to try to find something in copper where I could get in, some levels in here to put in some trades. I just didn't like the reward to risk profile. If copper came down into like the mid threes, like 350, 360, I would actually really like copper in there for defined risk trades. But something tells me, I'll just use this in blue, I think copper could do a lot of this. A lot of noise, a lot of nonsense until, if it comes down to a $4 level, I'll probably put on some defined risk trades in copper. That's about it. So if we come to $4, I like establishing some risk-defined trades on copper. I'm not necessarily needing to go higher, but if it comes low enough, I'll take a couple of stabs at it. That's all I'm doing. Okay. All right. So that's copper. Let's go back to this chart here. Right. And again, I don't want to spend a lot of time in this, but this is what the market doesn't know. I mean, we had a 1% to 2% gap lower from Friday's close to Sunday's open. Futures down a big amount. I posted this in my Telegram last night. So this was, the first thing I checked around 6 p.m. when the futures market opened. This is what I saw. ES down 1.9%, NASDAQ down, here's NQ down 2.61%. Since that gap lower, you can see the manipulation in price. This was the gap lower in futures. Here's S&P futures, gaps lower, all the way back down to the sell-off we saw from DeepSeek, which was last Sunday to Monday, and it came down to the same level and then came back up to try to fill today's gap. Here's NQ, down towards the DeepSeek levels. Once again, there's your Sunday to Monday open. That was that Sunday night futures market. And we end up spending all week responding, sold off on tariff rumors on Friday last week. Gap open, lower, equal low, didn't quite hit DeepSeek lows. NASDAQ rips up here to try to find some gaps, right? So there is just going to be a lot of intraday noise, a lot of intraday volatility. Traders that like direction and volatility, you're probably going to get it. Just be careful on what you trade. Just follow. I mean, you've got to follow very short-term flows In an example like today for NQ, I mean, you come down to the smaller time frames. I mean, we had a nice equal low, starts to turn green. You've got some points to the upside. Same thing here, gaps lower. I mean, a really nice support structure there at 20, we'll say 21,000. I mean, for 21,000, I mean, that the thing's up 475 points, right? But even grabbing this first little wave of like 21,000 to 21.2, it's like, hey, grab 50 points out of that, grab 100 points out of that. It's doable, right? I mean, it's good flow for a day trader. It's just, what did you expect? I mean, how bad did things get today? Well, didn't get that bad. And where did price go in the indexes? Well, we gapped lower, had a big surge right around 10:20 in the morning, and that green candle pretty much took out all of this nasty slide. And here we are coming back in towards filling the gap, and there's a nice little market maker level, liquidity level right around 60, 30 or so in the SPX for the day. So again, that's why I put the broken wing up here. I thought, well, if we're going to come back up and fill the gap, I want to be prepared for a little bit of flexibility up above that. So I pinned it at 60.60, which again, doubtful we're going to hit that today in the last 43 minutes of trading. So I'll probably just end up keeping that 45-cent credit. Okay. All right. So that's SPX for today. Copper I did. Let me read the best case, worst case scenario. So here we go. So best case scenario, and this is all a wait and see. Unfortunately, this is a wait and see, which is going to keep the markets on its toes and keep the markets on its heels. And we might have some gaps. We might have some volatility. The market might not give us any direction, but inflation doesn't rebound long term. The initial bump in consumer prices subsides quickly as reshoring leads to greater domestic supply and productivity. Then increased U.S. production, less reliance on overseas supply chains can reduce supply-driven inflation risks. Domestic boom for the U.S. Tariffs will make imported goods more expensive. Consumers and businesses overwhelmingly turn to made in the USA alternatives. U.S. production jobs explode in the surge. So again, this would kind of be like U.S. exceptionalism, which we've seen a lot of investors coming into the U.S. The U.S. stock market's been one of the best performing markets of all global markets. And the question is does it continue? Is it looking better elsewhere? I don't know. I don't know the answer to that. I think global economy wise, if things are looking somewhat good across the board, it's probably good for the U.S. It's probably good for global, reduce trade deficit. Higher import costs lead to fewer imported goods, strengthen the U.S. dollar. Probably not great for the markets if we see a stronger U.S. dollar, but it maintains probably a bid because any type of safe haven flows are going to go into gold most likely. Elevating the country's economic and geopolitical standing in the world stage. U.S. strengthens its borders, minimizes illicit drug flows, reduces reliance on foreign suppliers to key industries related to technology, AI, and defense. So that's improved national security. Best case scenario. Worst case scenario, inflation gets worse. Okay, and we can read between the lines here. Look, if inflation gets worse, core PCE last week printed the same. Everything was pretty much exactly as forecast in the calendar. We've seen CPI go up, PPI go up, PCE go up or sideways for the last year. Core PCE has not really been an improvement. The core PCE, if I go to core PCE quarterly index, let me just go this one here. That's not what I wanted. Core PCE month over month. Let's see if this is index annual change. There we go, 2.8. Okay, so where's the Fed funds rate right now? This is why the Fed has said they're restrictive. Fed funds rate is 4.25 to 4.5%, right? So let's put a line there. We'll put 4.25. I'll just put a box there actually. So 4.25 to 5%, or 4.5 there. So that's our Fed funds rate. That's our current core PCE. This is the Fed's preferred measure of inflation. Now, this does give the Fed some wiggle room that even if inflation goes higher, okay, they're still considered restrictive. The problem with that is how much more expensive are things getting? How much worse do we get as far as like choking out growth? Because if PCE continues to go up, if PPI, CPI continue to go up, if the U.S. 10-year yield continues to go up, I think we put in a decent top in the market then. The S&P might struggle to get back to 6,100 and change. The SPY and the Qs are respective all-time highs. They might struggle to get back to those highs. And I'm not saying we have like a nasty, ugly drawdown, but I'm saying that it's going to be very difficult to justify highs if things are getting more expensive and it's killing growth. Highs are based on these multiples that are like things are going to continue to grow and should continue to grow now and in the future, right? The markets are forward thinking. So as it stands right now, a funds rate up here with the current core PCE a little bit lower, this is why the Fed says we are restrictive. We are restrictive, right? There's your Fed. The issue, of course, would be with their monetary policy if they decided to raise rates, which is not off the table, but it's certainly not the highest probability. All right. So could inflation go up a little bit? Sure. Would it be awesome to see it going the wrong way? No. It's already been going the wrong way for 4 months. So does it get worse? I don't know. Okay. I don't think we can have the same trajectory we've had for 4 years. Inflation is not better. Okay. Yes, we spiked back in 2022. We've come down a long ways, but inflation is not better. US CPI. See if I can get it here. Consumer Price Index. Let's go. Is there a core CPI? If not, here, I'll just pull this up here. Is this making sense? So let's go to inflation data. Year-over-year CPI. Okay, so if I go back a little bit further, trying to go back. Okay. So we've come down from the peak. Change this to yellow. We've come down from the peak. Okay. But here's the issue. From where we hit kind of this low in summer of 2023, right here, are we any better? Right? Are we any better? Well, we had a lot of indecision there. That was a big, fat, no real progress on inflation. It's not going higher necessarily. Okay. But this was our next wave. So we went down here, got sticky for a while, went down here. The problem is unless this is short term up to come back down, maybe this is another sticky pocket of inflation. We keep it hold 2%, which is a long ways away. We're still like 45% away from getting to a 2% inflation target, right? So the point is, if this is trending up, and I would say what the market's really going to hate is if we go CPI year over year and it's greater than 3%. If this is greater than 3%, we are certainly going the wrong direction since September of last year. And we are no better off than where we were in the summer of 2023, which would mark 2 years, right? Which just inflation is not getting better. And that's not necessarily real inflation. That's just the Fed's measured data. If you want real inflation, then you probably need to keep an eye on the trends for something like this, which is what I also reference, trueflation. Now, this is actually pretty encouraging. And I don't know how this dropped like that, considering we're at like 2.6, 2.7. But if this is any indication of the next inflation data prints, this could be a good thing, right? If inflation is going to drop and it's reflected in the data, then maybe the CPI does improve, maybe the PCE does improve, maybe the PPI improves, maybe the US 10-year improves, right? If the dollar gets stronger, that should hopefully, well, I take that back. If the dollar gets stronger, that's usually going to show yields getting stronger. So let me go to US 10-year. Okay, so we're off the lows. We came down to 4.46. We're off the lows. It's slightly high on the day. It's still a red candle, but I don't love this either. So I listened to a podcast with Mike Wilson. I think it's Mike Wilson from JP Morgan. He said the 4.5, and change the color here. So 4.5 to 5%. Okay, 4.5 to 5% on the US 10-year is not good. Okay, not good growth. So limited growth, minor growth, markets priced to perfection. If we can't show growing on top of that, this is not good, right? That's why it's not a surprise that as we made this run up here, we ran into all-time highs, but we have hit what seems to be a big resistance level in the markets. Okay, so we have one all-time high for the year in the S&P. We don't have any for the others. If we go to the Dow, I don't think the Dow hit all-time highs, just shy of it. Okay, did the Qs hit all-time highs? Nope. How about the Russell? Not even close. Okay, so the S&P, and again, this is market weighted. S&P still well off the all-time highs. This is 1 for the year. And equal weighted, still gapping lower, kind of ugly. Equal weighted Qs, a little bit better. I mean, certainly performing what seems to be somewhat better and more resilient than the Qs here, but not great. So I think the easiest pattern to look at here, and I don't know if anybody loves trading this because it's not easy, right? It suckers in buyers and sellers. But if we have that type of look and that type of look, not a lot of traders love this environment. Now, I don't mind it because if we come up to these highs again, I'm going to look for something to drive us back down. If we come down to the lows, I'm going to look for something to drive it higher. So I think we are going to be in limbo for a while. And you could call this, Q1. You could call this the first half of the year. But until there's some more momentum and clarity and we can put some things behind us, I don't think the market has what it takes to price in a lot of good optimism, nor price in a lot of terrible things either. Because it's not that bad. Like, companies are still making money. Consensus-wise, things are still growing. Earnings are coming in fine. We saw Mag 7 especially like beating top and bottom for the most part. Prices aren't moving a ton, but still, I mean, they're at least making money, which is what the market wants to see. So flight to quality, probably a big thing for 2025. If you're trading stocks that you think are undervalued, but there's a reason they've been down in a bear market and they're not profitable and they have a lot of debt to the name, I would probably steer clear of all that crap this year. Right? I'm doing a lot of my trading focused on index trading because it's way less volatile. Right? If the index is down 20%, you're going to have stocks down 40, 50, 60%, maybe more. I don't think anybody thinks about this, but in 2022, who can tell me how deep the discounts were, how bad the drawdowns were in some of your favorite stocks? How bad of a discount was it in Nvidia during 2022? Does anybody know? Look at 2022. Okay, there's 2021. We peaked in November in the NASDAQ. So any tech stock here, that was a nasty bear market. Nvidia was down 67%. Now, this is supposed to be one of the greatest performing stocks ever in the history of the stock market, but it was down from all-time highs 67%, right? And you're like, oh, it didn't really matter. I just stayed in it. Well, yeah, maybe it did. But if you're all in on a stock, you can see you have a lot of volatility to deal with. So an index that was down 20 to 30% is a lot more tolerable, a lot more manageable for your emotions to understand that, yeah, every year we can expect maybe a 5 to 15% pullback in a healthy market. If it gets a little bit sketchier, then yeah, I'd say 10 to 25% pullbacks are going to happen. So I'm trying to avoid a lot of this excessive volatility by trying to pick these favorite stocks that might turn out to be crap. So I'm going to trade a lot of indexes this year, right? I'm trying to reduce a little bit of volatility, stay somewhat diversified, where, it's going to take a lot to crash the S&P and the NASDAQ and the Dow and the Russell all at the same time. It can happen. We can have a bear market, right? But if this market's excited about anything and optimistic about anything, I don't think we're necessarily going to hell in a handbasket. All right. So just throwing it out there. All right. So NVIDIA, we're back down to the 200 moving average. I put in some puts today. I'm looking at a gap fill. We've got earnings on NVIDIA at the end of February. And I was reading more on like the DeepSeek stuff, and a lot of that is still trying to be flushed out. But I think NVIDIA chips are actually used for a lot of the DeepSeek stuff. It was just showing that you didn't need like tons and tons of them. But if it drives prices down, it's just going to make NVIDIA chips more appealing right now. So I don't think that NVIDIA is necessarily in a bad place. I think technically speaking, it looks like a good spot to be buying. And I'd love to see like either this is a flush down for NVIDIA to gain, or we come back down to these August lows and all of a sudden put it like right at maybe a fair value. But I think look at the lows. Look at these lows. Low back in April of 2024, low in August of 2024, and a low right now. We're right back at the 200 moving average. If we see a bit of a breach below this 200, but it closes back above, that's probably an indication that this thing can go back up to potentially all-time highs, or we have a range that we are going to be trading on NVIDIA. So if NVIDIA, one of the largest companies in the world market cap-wise, is trading in a range, guess what happens to semiconductors? They're probably trading in a range. Guess what happens to the NASDAQ? Probably trading in a range. What happens to the S&P? Probably trading in a range. Lots of highs and lows. All right. So, question out there for everyone watching: how prepared is your portfolio? How prepared are your strategies to give you income, whether the market is going sideways, down a little bit, down a lot, up a little, up a lot? I'm just trying to stay out of the way. I think the market is still somewhat bullish, okay, with a lot of uncertainty that is going to drive the markets crazy. Like, let's see if we get back to the highs again, okay, fine. I think it's a bunch of noise. I'm probably going to short. I'm probably going to take on some hedges. If we end up breaking these fresh lows and going lower, we're talking revisiting holiday lows. We filled the election gaps already. We've got a nice measure move down to this 200 moving average. I could see this level right below the 200 back above it. I could see that as the Q1 or the first half of the year kind of bouncing point, if that's where we come back to. So I'm way more bullish. If we have further discounts. I'm not as bullish if we're getting up to all-time highs and struggling to have any significant momentum. And I could be wrong, right? If all of a sudden it's like, oh, all-time highs and it just keeps going and going and going. Well, to me, this is great for the interim, but this is a ticking bubble, in my opinion. That we get to this price that are so high valuations that we're going to end up having a nasty correction. And again, I'm just going to keep these technicals because, look, if you connect the dots here, this high, to, let's say, a future high, and this low to a future low. If this market finds a way to find the 200 moving average or this low, I like this as a buying opportunity. If this market finds a way to go to these highs, I look at that as a selling opportunity. It's that simple. So I am a opportunistic buyer in the right zones, and I will be waiting patiently for a turn of some type of price action to then give us, some type of decent correction. I just think somewhere between a 10 to 20% correction is more likely. 20%, especially if we get to these highs, I'd say from current levels, traders need to be braced for something in like the 10 to 15% area. If we have corrections and pullbacks, be prepared for like high volatility. Even if the market's an overshot and it's an overreaction, 10 to 15% to the downside makes some sense, right? So the nice thing is a lot of my strategies, I can still make money even if the market is down 10, 11, 12%. And I have enough time in those trades that as long as they get to that 10% level and then respond to it, I still make money. Okay. All right. So we will see what happens. All right. On the day, so a little bit of red out there. It's fine. A lot of it is the increase in volatility. Some of my ratio spreads are under some pressure as the prices and stocks are dropping. It's understandable. I'm just going to give those a little bit more time. I'll take a look at those positions. But that's index discussion. Let's go dollar, gold, silver. So the dollar, big spike up and a rejection. You can take a look at your euro dollar and some of those related currency pairs. So we nearly had a gap fill on the dollar today. So here's euro dollar gapping lower and came up a decent amount to try to fill the gap today. If it does fill the gap, cool. It wouldn't surprise me if it did. So maybe the market is, let's look at a smaller time frame. Let's go on the 15-minute chart. Okay. So here's what I would like to see. And whether I trade it or not depends on the setup. But because we still have a decent sell zone, this is euro dollar, okay? If we go back to this 200 moving average and come back down, I'd look to see if this level holds as support, break a trend line, get above this 200 moving average, and then look for a gap fill. That to me is the cleanest trade without trying to call or catch the bottom, right? If you did trade the bottom, give yourself like a 50 to 100 pip stop loss, trade small, maybe scale into the area, but see if this level holds and then ultimately does make a gap fill. If the market just keeps going and going and going and it's a gap fill, well, that's just a noisy move. Gap lower, disrupts a lot of trading, comes back up to fill the gap. It is what it is, right? But the nice thing is it's not doing any major damage to fresh lows. Now, if this trade war talk continues and Europe is brought into the mix, then this conversation of the Eurozone going down to parity, the dollar getting stronger, this could make things a lot worse. But right now, we're just dealing with a lot of chop around this 105 to 103 zone. We're trading at 103 right now. There's been as low as 102. Parity is obviously it's a big target. It's a nice round number, but I don't want to be stuck in all this nonsense. When look, if we get down to parity, then I'm fine with a buy level down here, right? But if we come back up to like 105 or 106, maybe this is resistance, and we ultimately do have another sell side on the euro dollar, right? But if this comes back up off of lows, gets all the way back to 106, pulls back again, this could be a nice little head and shoulders pattern, and then the euro dollar possibly heads higher. I don't know if the dollar is going to get that much weaker. It'd be lovely to see it, because if the dollar gets weaker, then sure, dollar gets weaker, US 10-year goes with it, stock market has room to go higher. I mean, that's kind of the win-win scenario if you ask me. But this trade war stuff is probably going to favor from some dollar flows right now. Oil, a lot of chop. Let me actually check and see. So oil's back down. Let me see how my CL positions are doing. So CL, I have right there. This trade is up a whopping $5. I'm looking for about a $200 profit. I'd be happy with $100, which is a 50% profit target on the strangle, or the iron condor rather. But I'm up $5. So that right now is a waste of my time. But I mean, price is right in the middle. So here is it's a 13 delta on the call side. It's a 16 delta on the put side. Price is right in the middle. I've been in the trade for 5 days. So, I mean, if this gets to like 21 plus days, or the DT at 21, hopefully this thing is going to get about 50 to 75% of the max profit. And I'll take some profit if we're sitting right in that sweet spot in the middle. But oil wise, again, just very noisy. What's price and oil going to do? I don't know. Maybe we're not going higher than 81 and we're not going lower than 67, and there's not a lot of drama there. Okay, natural gas up off the lows. I do have a long trade on natural gas. This one is fine if I get a breakout. Let me see if we can break some recent highs at 20. Recent highs back here in the earlier 2024. That's summer 2024. I've got a diagonal spread where I get it called away at 23. Gold, decent push today on gold for some safe haven flows, well above those recent highs. I'm still not a super, like timing wise, I'm not a Super Bowl on gold. I am benefiting from gold going higher. I do have shares in of GLD. I have credit spreads and all sorts of income generating strategies, but I would love to see a pullback on gold. And I don't know if it's going to be just a big, nasty turn for the worse, or if it's going to be gold just goes up here, gets really boring, right? And allows these moving averages to catch up. And then we have a pullback on gold, and then it becomes a buying opportunity. But look, if I just spot check gold every single day this year, and all I'm going to wait for is I will buy the dip, then that's my plan. I'm going to buy the dip. Okay, but I'm going to hold off on just adding a bunch of positions on gold right now. There's GC futures, there's GLD. I've got leaps and credit spreads and shares. Silver looking a little bit better. I want to see if this hits 32.25. SI futures, I just closed out for about $500 or $600 last week on SI futures. SLV looking good as well. Just going to hang on to it. I've got a diagonal spread. Trying to get this thing up into the $33 to $34 zone. Bitcoin, I did miss that 92K dip for the day. However, I don't think this is done. So I think that this high, this low, as I said with the indexes, expect some volatility. Don't be surprised if Bitcoin also faces some volatility. So look at this as resistance. Look at this as support. And if it comes in low enough, I said 90K. It didn't quite get there last night. It was close. I was watching on my phone, 91.7. I posted on Telegram. Here's my screenshot. Well, I saw it. I down. This is on my phone with TradingView app. But I saw it was like 93 and change. I was like, well, okay. But it came down to 91.5. And, I'm still liking this like 90K mark, 80K mark, but I didn't get the trade that I wanted. So I'm waiting. Bitcoin related assets. Here's MSTR 345. Big push to the upside. This was down as low as 309, got bought immediately, just like Bitcoin did. I am probably just going to leave the shares alone right now with a collar trade, 310 by 240. My break even's around $279. I get it called away at 310, so I'm making about $31 a share on MSTR. Coinbase looking fine. Ethereum, holy Toledo, look at that thing. Oof. All right, I'm not touching Ethereum. I mean, again, this might be, buy the dip. It's like, maybe. That's a lot of volatility once again. So be careful on Ethereum. Looks a little bit more volatile than Bitcoin. Maybe it still heads up and tests the highs again. But that's a little, I don't know. I think Bitcoin is a bit cleaner right now, so I'm just going to stick with Bitcoin. EETH. I'm glad that I kept out of the way. So I had a lot of $60 was my line in the sand, 65 line in the sand, 45 line in the sand. All those trades were profitable at the end of December. Copper, we talked about earlier. Japanese yen, anything here on 6J? Not really. I'm hoping that by September we see a stronger Japanese yen. I don't know if that's good or bad for the market, if that's good or bad for currencies and currency wars. I'm taking a stab on futures for a small risk. I mean, it's manageable. It's less than 1%. It's about a third of 1%, but the profit is about half of 1%. Okay, Nikkei here, still very indecisive from the high to low from July to August last year. FXY, I'm long on Japanese yen there. EWJ took a couple of dollar cost average position. The DAX took a big gap to the downside. FTSE, big gap to the downside. I mean, pullbacks are fine. I mean, if you get a pullback in any of these moving averages on the DAX, looking for buying opportunities. If you get a pullback on the FTSE, this one looks a little bit better structurally. It really does. Like FTSE finding some dynamic support looks a little bit more resilient. The DAX has had such a strong run. I almost wonder if we have a pullback into this area and you have a dead cat bounce, I could see the DAX actually falling. If trade wars come into Europe, expect the DAX and the FTSE to go down. So I don't. I would watch that as far as a story that the market wraps around, makes it harder in Germany and the UK to see the indexes go higher. Argentina, a lot of indecision. I'm still waiting for some pullbacks if we get them. There's China looking a little bit higher. There's Brazil looking a little bit better. Apple, indecision today. Amazon still showing resilience. Google has earnings. We're sitting at all-time highs. Meta just off of all-time highs. It took an earnings play last week for a small win. Nothing awesome there, but it still was a winner, which I'll take. Microsoft got a bunch of income trades. That profit trap was hit, or that was it wasn't a profit trap. It was just a broken wing credit last week that I took money on. This is 1, 2, 3, 4 trades on Microsoft that I'm out to March and April. I think I'm good on this trade for right now. I think I'm good. Netflix, just off the all-time highs. I do have a broken wing butterfly up here. As long as price stays below 1030, I make $1. If it stays in the 1040 zone, that's profit trap at like 13 or I think it's like $12 or $1,300 profit trap. That is out. Let me check my Netflix expiration on that one. Netflix expiration is, here it is, February 28th. So by the end of this month. So if we have a lot of indecision, then good. That would be at least $1 credit. If I have a profit trap, it's profit trap. NVIDIA, I'm going to look for some type of gap fill in the coming, I'd say the coming month or so. Yep. This level's 129, gap fills all the way up into your 142. Earnings are at the end of this month. So, I mean, if there's some resiliency in NVIDIA, that's fine. I have some cash secured puts. I've got some debit spreads. I've got an iron condor that's threatened on the put side right now, but I'm not going to move this because this stock can certainly rip higher. So I'm just going to hang on to it. And on the iron condor, I might be willing to own some shares. Okay, Tesla down a little bit. Did we hit the 362 level? Not yet. I still have a dollar cost average position in at 362.50, not filled yet. I have a bunch of ratio spreads for February and for March. I don't know what the income is here. This was for 217. Let me check the 280. Let me look at the 280. 228 credit. So this one is 228 credit. So between these two with no ownership, that would be $4 and roughly $4.40, $4.50 per contract. So if Tesla is not all the way back down to 275 or 255, then there's no assignment risk. And I just look at this as hopefully this is going to just kind of maybe slowly work its way lower, give us an accumulation type pattern, see if this area holds as support. And then if Tesla's going to find some bid and some rips, then this is a great spot to be getting long Tesla for revisiting all-time highs or higher highs. I don't know, in the coming 6 to 12 months, the coming couple of years, I'm not really sure. So it could be, I mean, if we're getting like under $300, Under $300, I'm saying I'm interested in owning some Tesla. Okay. Do you think the new FASB accounting regulation will favor MSTR's earnings on Thursday? I don't even know what you're talking about. Is this something with putting like Bitcoin treasuries on the company balance sheet? I think MSTR is basically just a proxy for Bitcoin. So take it for what it's worth. I mean, I'm trading MicroStrategy as a kind of a leverage way to correlate with Bitcoin. It's just because the premiums are so good. I'm just basically doing buy right strategies and adding a collar so I can have downside protection. But I don't know. I mean, probably more importantly would be MSTR has earnings, and I think it's this week, right? So we have earnings Wednesday after market. I didn't even see that on, surprisingly, Wednesday. I don't see MicroStrategy in here at all, which shame on Earnings Whisper, unless it's just based on big market cap. But all these in yellow, by the way, PayPal, AMD, like the trades. So thoughts on Intel? Fundamentally, I don't like it. Fundamentally, this stock is just hanging out at 20 bucks. I think this is it's a level one in my opinion. So if you were willing to allocate to Intel, I think buying at $20 and buying again at, let's say, $12, $13, that would be my play on Intel, right? So $20 and we'll say $13. That would be my play. So I would not allocate fully here. I don't think the stock's going to have a lot of good movement at all. I think we might come back into this 20. This is a 2008 and a 2002 low, which are terrible lows to be referencing, right? I mean, the fact that this stock has gone up in a .com burst, so this stock was up, 3,000% and then crashes. And then it rebuilds, has a nice equal low during the great financial crisis, goes up another 447%. Change the accounting rules regarding holding crypto assets in the balance sheet. Yeah, that's what I thought you were. I didn't know that it was called FASB accounting, but I just was assuming it had something to do with because they're kind of pioneering the idea of like, hey, we're a company, we've got Bitcoin on our balance sheet, and there's more publicly traded companies talking about it. Yeah, I mean, if that's the case, then that makes MicroStrategy even more valuable. You know, so look, if it works out, it's certainly advantageous for MicroStrategy to have Bitcoin and have that market value included, because that's sitting on like billions of dollars of valuation based on the spot price of Bitcoin with the 130,000 coins they have on Treasury, right? I mean, Michael Saylor alone has like, I think, over six figures of Bitcoin, and MicroStrategy itself has like over 100,000 of Bitcoin as well, which is insane. I mean, it's kind of it seems like a pretty all-in scenario for a struggling tech company. But if they get market value on top of that, then I mean, MicroStrategy, I don't know why it should be this, but it's like, could it be one of the? I don't know. I'd be really suspicious and think like that could be a crypto bubble if MicroStrategy, based on that accounting method and that fair market value, is given all the credit of like, hey, this company is worth $15 billion on paper because of their Bitcoin holdings. Well, that covers all their debt, that covers all the lack of profitability, that covers all their cash flow. But if they never sell their Bitcoin, they don't do anything with it. It's just there as a spot holding, you know. So I don't know. And if I don't know, I'm not going to speculate on it. But it would be crazy to see, like, could it become one of the world's most profitable companies? Maybe, but I don't know. So what am I doing with MicroStrategy? Well, I'll make like 10 grand. If I get my strategy right where it gets called away at 610, I make 10 grand. Cool. So can I do it again? Sure. I'll try to do it again. I'll try to lower the cost basis. And we have earnings this week, so we'll see what the earnings reaction is. Yeah, fifth biggest Bitcoin holder worldwide. I know. And Michael Saylor has been on a mission for a while. So it's pretty wild. Okay, so Intel, back to Intel. $20 and $13. I don't think it's a bad spot to dollar cost average in. The only thing that makes me hesitate on Intel is this. Fundamentally, this stock should not even be at 20 bucks, right? Doesn't check like it doesn't have a lot of risks here. Trading well below estimated. This all get changed, by the way. Okay, this was not that. Like in the last couple of months, this was like $5 or $6. So this has all been updated. This looks a lot better. Price to sales of 1.6. Price to earnings, not too bad. Okay, well, Intel just got a nod in my book. So that's weird. Now, there's a couple ways you can trade this. Intel at 1.6 times price to sales, it is getting smoked by its competitors. Micron, even, I mean, it's not that expensive. So at $19, there's a couple ways I can trade this. One is I can buy the shares outright, and I can allocate a couple $1,000s to it. Right, own 100 shares, it's cost me $19.40. If I own 2,000 shares, I'd have to allocate in cash. So let's say $19.40 plus, let's say $1,300. For $32.40, I can own a 100 delta full long, no time factor, and just own the shares. Break even is going to be around $16.50, right? 20 plus 13 divided by 2, 1650 break even. Does this stock have what it takes to go anywhere? I think that's the issue, is like, what if we're in this environment? What if Intel does nothing more than range? What if that's all we do? Well, I mean, we did have these spikes up into the 20s and 30s, so I don't think that's a bad trade just to go after short-term profits. So let me consider this. We got 8 minutes here. I can revisit this trade tomorrow morning. I'm going to put Intel back on the list for the week. Okay. Because let's zoom in here on the daily time frame. I do like the potential gap fill here. So, anything long that gets me up to the $28 mark, I don't mind. The premiums aren't awesome. I will say that. Now, how much does it cost me to go out? If I went out to like 2027, which I know is a long ways out, but this is a diagonal spread. So if I do a January 2027 and I buy, this is going to Intel. Okay. So I bought, I'm already in this trade. Intel. Okay, so I already did this trade. I bought it at $3 and I sold it at 22. I mean, so right now, based on the break even, I am in this trade for a net of 3 plus 17.32 minus $1.06. Get it called away at 22. I'll make $2.74 a share. It's an income trade. Now, the goal is to keep selling against this. I also think at 1940, maybe I can just have the shares and get them called away. Okay. Now, what I probably end up doing is if price gets greater than 222, then I will close this trade out together. So I'm going to close these out at, not now, but I'm going to close this out as a diagonal spread. If I were to buy the shares right now and just say I'm going to do a 100 share allocation, then I'd put the $1,900 to work. Okay. And I would hold this until we probably hit like 20. This recent level is like 26. This gap fills around 28. I would like that spot. We do have earnings that came in positive. We have earnings again in April. This is the semiconductor space, which I think the only drawback with Intel is like they're just behind NVIDIA and they're behind this like current semiconductor space. They are a big chip maker. That's what they do. That's their bread and butter. I do think when Intel eventually catches up, they could be great. I just don't know if that's going to be like I sit on a stock for, a year or two before it actually pays me anything. So I think what would be wise would be, what's the percentage here? If I bought in like $1,000 and it goes up 50, I mean, that's not bad. All right, I'm going to do this. I'm just going to take a $1,000 position at 20 and a $1,000 position around 13.50 instead of take profit. So that is, down to 30. Yeah, I'll do that. So I'll do $20 and 13.50, and I'm going to do a $1,000 allocation to each one. Okay, so right now, if I take $1,000 divided by 19.39, I can buy about 51 shares. $1,000 divided by 19.40, I can buy 51 or 52 shares. Okay, so I'm going to go long the stock. Long the stock, 1940. Let me go 51 shares. Okay, I'm doing this across the board. 51 shares. Okay, everyone's going to get a piece of this. Let's do 7634. This is fine. Okay. $16.08. 6761. Go to 41 perhaps. Filled at 41. Okay, a couple more accounts. 336. This one I'm going to do 100 shares in this one. Actually, no, I'll just keep it at 51, just in case. That's a cash account. Okay, so I just added that in to a $1,000 allocation on Intel. So this is all accounts, $1,000 allocation, which is 51 shares at 19.41. That's the high end of what I got filled at. I'm going to put in a pending. How many shares can I buy for $13.50? I can buy 74 to 75 shares. 74 shares at 13.50. So I'll make that a pending order, and I can get that in. So I need to add in the 13.50 pending. All right, I can get that added in for tomorrow. Unless I doubt I have enough time here. We're on the final 60 seconds of the day. My SPX trade for the day is going to close out. So this bonus trade for SPX daily profit play. Update here. SPX broken wing butterfly. 45 cents credit. Full profit with end of day expiration. Okay, so we've got 1 minute left. Closing bell. Price closed at 59.93, well above or well below my 60.60 mark. So I can take that profit on the day. It's another 45 cents. There we go. Okay, so all in all, not a terrible day. A lot of trades getting thrown in there, so that makes it at 69 trades on the day. I'll add in a 13.50 pending order, which I think I can still do that here. Let me go long stock, see if I can get these in. So 13.50, change this to 74, see what the allocation looks like. Yeah, I can just put these in pending. So working will begin next valid session. That's going to be right at $1,000 allocation. Okay, that's fine. I'm gonna go 1250. So 1250 divided by 13.50 is 92 shares. All right, let's try that. So 92 shares sets me back around 1250. That's fine. And I'll copy and paste that elsewhere. So everyone gets some of that. So that's for 92 shares. Replace similar. Okay, keep going. All right, a couple more accounts to get filled in. 7634. Okay, 1608. Almost there. Okay. There we go. Okay, so make sure this is 1350, 1350. Got it there. Got it there. Got it there. One more. One more. One more. One more. Good. Okay, so Intel is in. $20, 1350, just pending orders. I'm doing a $1,000 allocation here. And this one is a 1250 allocation here. Okay. And look, if I have the shares and they go up to $26 to $28, I'm fine just getting rid of it. I mean, I'm not interested in like dealing with like, oh, I'm going to hang on to it forever. Look, it could be years until we see $50 to $60 on Intel. So for me, if I'm getting in low enough and it settles in, pops up here on something positive, optimistic, whatever, then I'll take the, I mean, it's still a good profit. I mean, 40, 50% profit is still really, really good. So I'm going to look at to see if this fills. I mean, this is a nice little pocket for me. And if price is sitting here at these lows and pops back up to that level, anything in that sweet spot for me is good enough for profit. SPX, same as SPY 500. I mean, it can be. There's different symbols, but you can trade SPX. You can trade S&P. What's the other one? SP 100 or US 100 or SP 500, US 500. So for CFDs, if you're a non-US trader, you can trade US 500. You can trade SPX. So there's SPX for the CFDs. There's S&P 500 SPX. That's what I trade on my broker platform is SPX. I trade the SPY a lot for the ETFs, which is an exchange traded fund. It's like 1/10 of the price roughly. But yeah, they're similar. Like tick for tick and dollar for dollar, they're moving percentage wise about the same. It's just the SPX is 10 times the price, give or take. Okay. Okay. That being said, I will let you go for today. If you're watching on youtube.com/financial wars, kindly hit the thumbs up button and subscribe to the channel if you have not. I'm using that channel almost every day for my final hour session and my personal YouTube channel and Facebook and Twitter and all that stuff. That's youtube.com/Chris Pulver. So any thumbs up helps, support the channel, all the good stuff, free content, right? Just here to help. Hopefully it does. So we got some live trading sprinkled in with what the heck's going on. I'm going to put some videos out for TradingView as well. I did a lot of those last year. I'm going to keep doing those just for some, I don't know, it's a huge trading community, so I'll share some ideas. All right. All right, everybody. Good stuff today. We'll come back and give it a crack tomorrow. All right. See you. Bye.